Imagine buying a $20 pizza, but 5 years later, you realize that pizza actually cost you $75. Sounds crazy, right? But this is exactly how millions of Americans slowly fall into the credit card trap. In fact, the average American household has over $8,000 in credit card debt. And the shocking part? Most people don't even realize they're trapped until it's already too late. So today, we're going to uncover how credit cards quietly trap millions of Americans, and why escaping the system is much harder than you think. Credit cards were originally created for convenience. Instead of carrying cash, people could simply swipe a card and pay later. It sounded like the perfect financial tool. Banks promised rewards, airline miles, cashback, exclusive perks. But behind all those shiny rewards lies a system carefully designed to keep people in debt for years. Because here's the truth most people never think about. Banks don't actually make their biggest profits from people who pay their balance in full. They make their real money from people who carry debt month after month. And once you understand how the system works, you start to realize something surprising. Credit cards are not just a payment method. They are a psychological system designed to encourage spending. Several studies have shown something fascinating. People spend significantly more money when they use credit cards compared to cash. Why? Because when you pay with cash, you physically see the money leaving your hands. Your brain feels the loss immediately. Psychologists call this the pain of paying. But when you swipe a card, that pain disappears. You're not actually losing money in that moment. You're simply delaying the consequence. And that tiny psychological trick changes everything. Suddenly, buying a $200 pair of shoes doesn't feel like losing $200. It just feels like a swipe. That's exactly why restaurants, online stores, and retailers love credit cards. The easier it is to pay, the more people spend. And the more people spend, the more debt they accumulate. Now here's where the trap becomes dangerous. Every month, credit card companies give you a choice. You can either pay your full balance, or you can pay the minimum payment. At first glance, this looks incredibly helpful. Imagine you owe $1,000. Instead of paying the entire amount, the bank might allow you to pay just $30 this month. Sounds convenient, right? But here's the catch. That minimum payment mostly covers interest, not your actual debt. So even though you're paying every month, your balance barely goes down. Sometimes it can take years or even decades to fully pay off a credit card if you only make minimum payments. And during that time, interest continues to grow. Credit cards typically have interest rates between 18% and 30%. That's incredibly high. To understand how dangerous that is, imagine this. You buy a $1,000 laptop using your credit card, but you only make minimum payments. With interest, that laptop could eventually cost $2,000 or more. You literally end up paying double. And millions of Americans experience this every single year. In fact, credit card companies earn tens of billions of dollars annually just from interest payments. That means the longer people stay in debt, the more profitable the system becomes. Another clever part of the system is rewards. Cashback, travel points, sign-up bonuses. On the surface, these benefits look amazing. For example, you might get 2% cashback on every purchase. But think about what that really means. If someone spends $1,000, they earn just $20 back. However, if that same person carries a balance with a 25% interest rate, they could pay hundreds of dollars in interest. In other words, the rewards are tiny compared to the cost of debt. Yet those rewards are powerful enough to encourage people to keep swiping their cards. Another subtle trap happens over time. Let's say someone gets their first credit card with a $1,000 limit. At first, they might only use a small portion of it. But after a few months, something interesting happens. The bank sends them a message. Congratulations, your credit limit has been increased to $3,000. At first, this feels like a reward. But in reality, it simply allows people to borrow more money. And the higher the credit limit, the easier it becomes to accumulate larger debt. Over time, some people end up with $10,000, $20,000, or even $50,000 in credit card limits, which means the potential debt keeps growing. Here's where things start to spiral. Imagine someone has 3 credit cards. Card 1, $2,000 balance. Card 2, $3,500 balance. Card 3, $1,800 balance. Individually, each balance might seem manageable, but combined, that's $7,300 in debt. And with high interest rates, the debt keeps growing every month. Suddenly, people find themselves working just to keep up with payments. Not to build wealth, not to invest, but simply to stay afloat. And this is exactly how millions of Americans slowly get trapped in the credit card cycle. Life is unpredictable. Cars break down. Medical bills appear. Unexpected expenses happen. When people don't have enough savings, they often turn to the easiest solution: credit cards. At first, it feels like a lifesaver. But once the emergency passes, the debt remains. And with high interest rates, that temporary solution can quickly turn into a long-term burden. There's another hidden reason people fall into credit card debt. It's called lifestyle inflation. As people start earning more money, they also start spending more. Better phones, nicer restaurants, expensive vacations. And since credit cards make spending easy, the upgrades happen gradually, swipe by swipe, until one day, the monthly payments become overwhelming. Once someone is deep in credit card debt, escaping becomes incredibly difficult, because a large portion of their income goes toward interest payments, which leaves less money available to actually reduce the balance. And that's exactly why the system works so well for banks. Because the longer people stay in debt, the more profitable the system becomes. When people start feeling overwhelmed by credit card debt, banks often present what seems like the perfect solution. It's called a balance transfer. The offer usually sounds something like this: transfer your debt and enjoy 0% interest for 12 months. At first glance, this seems like a lifesaver. Imagine someone owes $5,000 on a credit card with a 25% interest rate. Moving that balance to a card with 0% interest sounds like a smart move. And sometimes, it actually can be helpful. But here's the part many people don't realize. Most balance transfer offers come with a transfer fee, often around 3 to 5%. That means transferring $5,000 might instantly cost $150 to $250. But the bigger problem happens later. Because when the promotional period ends, the interest rate often jumps to 20 to 30% again. And if the balance isn't fully paid off by then, the cycle continues. Many people end up transferring their debt again, from one card to another, year after year, never actually escaping the debt. Another common pattern appears when someone struggles with credit card debt. They open more credit cards. Why? Because new cards often come with attractive bonuses. For example, spend $3,000 in the first 3 months and earn 50,000 reward points. Those points might equal a free flight or hundreds of dollars in rewards. But to earn them, people often spend money they didn't originally plan to spend. And sometimes they can't pay it off right away. So the debt grows again. Over time, some Americans end up with 5, 10, or even 15 credit cards, each with different balances, different due dates, different interest rates, and managing all of them becomes incredibly stressful. Debt doesn't just affect money, it affects psychology. Many people fall into something called the debt cycle. Here's how it usually works. At first, someone uses a credit card for convenience. Then they carry a small balance. The interest grows. Payments become stressful, so they use another credit card to handle daily expenses. Now the debt grows faster. Soon they feel overwhelmed. And when people feel overwhelmed, they sometimes avoid looking at their finances altogether. Statements go unread, balances go unchecked, and the problem silently gets worse. Another hidden cost of credit cards is penalty fees. If someone misses a payment, even by just a few days, they may face a late fee of $30 to $40. That might not sound huge, but it adds up quickly, and sometimes it triggers another penalty, a penalty interest rate. Some credit cards increase the interest rate to nearly 30% after missed payments, which makes the debt grow even faster. This creates even more pressure on the borrower. It might sound surprising, but credit card companies actually prefer customers who carry balances, because those customers generate interest income. People who pay their balance in full every month are often called deadbeats in the credit card industry, not because they're irresponsible, but because they don't generate interest profit. Instead, The most profitable customers are those who stay in debt for long periods. And the system is carefully designed to keep that cycle going. This isn't just an individual issue. It's a national trend. Americans collectively owe hundreds of billions of dollars in credit card debt. For many households, credit cards have become a normal part of daily life. Groceries, gas, online shopping, subscriptions, everything goes on the card. And when spending becomes invisible, debt grows quietly. The good news is that escaping credit card debt is possible, but it requires discipline and a clear strategy. One popular strategy is called the debt snowball method. This method focuses on paying off the smallest debts first. For example, credit card A, $500. Credit card B, $2,000. Credit card C, for $1,000. Instead of spreading payments evenly, someone aggressively pays off the $500 debt first. Once that's gone, they move to the next one. Each victory builds momentum, and over time, the entire debt disappears. Another approach is the debt avalanche method. This strategy focuses on the highest interest rate first. For example, Card A, 30% interest. Card B, 24% interest. Card C, 18% interest. The borrower pays off the 30% card first, saving the most money on interest. It's mathematically more efficient, but it can take longer to see progress compared to the snowball method. One major reason people rely on credit cards is emergencies. Unexpected expenses can destroy a budget. That's why financial experts recommend building an emergency fund. Even saving $500 or $1,000 can prevent someone from reaching for a credit card during a crisis. Over time, that small safety net can make a huge difference. Despite the risks, credit cards themselves aren't inherently evil. When used correctly, they can actually be helpful. For example, they can help build a strong credit score. They can offer fraud protection. They can provide rewards for spending you were already going to do. But the key rule is simple. Never spend money you can't pay back immediately. If someone treats a credit card like a debit card, paying the balance in full every month, the trap disappears. Because interest never accumulates. The real lesson isn't just about credit cards. It's about understanding how financial systems influence behavior. Companies design products to maximize profit, which means consumers must stay informed. Because small financial habits repeated over time can either build wealth or create years of debt. Credit cards can feel like freedom. They allow instant purchases. They offer rewards. They promise convenience. But behind that convenience lies a powerful system of interest, psychology, and incentives. A system that has trapped millions of people in long-term debt. And the only real way to avoid the trap is to understand how it works. If you found this video helpful, make sure to subscribe for more videos about money, psychology, and how financial systems really work. Because understanding money might be one of the most important skills you'll ever learn. And sometimes, the smallest financial decisions today can shape your entire future.